Good morning and welcome to our fall market outlook. Oh my God, where do we start? How about with these recent headlines? Predicted worldwide food shortages, runaway inflation, housing bubble bursts, 5% reduction in Canadians' net worth in 1 quarter, rapid rise in interest rates, unpredictable stock markets, European energy crisis. Whew, what does all this mean? Well, we're about to get some insight. I am joined this morning by Elliot Bourgeois, manager here at Welch in the Family Wealth Advisory Practice, Craig Bassinger, chief market strategist at Purpose Investments, and Pierre Cleroux, vice president, research and chief economist at the BDC. Thank you for joining us, gentlemen. Just before we kick it off, you will note that we are recording this session. The chat has been disabled, but we welcome your questions and answers. So please, our answers, your questions, please put your questions through. So Pierre, maybe we can start it off with you, please.
Thank you, Michael. I'm just going to share my screen. So just give me 1 second here. Oops, just give me 1 more second.
Yep, that's fine.
Yeah, well, thanks for being here with us today, Pierre, and we look forward to some BDC commentary on how the Canadian economy is shaping up comparatively to our world counterparts. So this is going to be very pertinent for a lot of our viewers. Thank you.
Do you see my screen now, or
not yet?
Not yet. I'm sorry about that. I don't know what's. We did it 5 minutes ago. It worked. Now it doesn't work.
Yeah.
Let me.
We can.
Here we go. I see it now.
You see it now?
Yep.
Yeah.
Okay, perfect. So you see my screen now?
Yes.
Okay. So like Michael said, there's a lot of talk about the next recession. There's a lot going on in the economy. There's not a day in the media that we don't call for a recession. There's some economists who say we'll be in a recession next year. Actually, 30% of Canadians believe we are already in a recession. So I'm going to try in the next 10 minutes to answer those 2 questions. First, I'm going to talk about where we are. So are we in a recession right now? Second, I'm going to talk about the next 12 months. What should we expect for the next year? So this is where we are today. This is the GDP. So this is the economic growth in the country. As you can see, we had a major recession in 2020, a major recovery in the 3rd quarter of 2020. Today, this is where we are. This is the 2 first quarters of this year. Growth in Canada annualized has been 3.1 for the 1st quarter, 3.3 for the 2nd quarter. So the potential growth for the Canadian economy is 2%. So this is higher than the potential growth. Actually, according to the GDP numbers, we are running very well. We're running over capacity. If we look at the job number now, there's 400,000 Canadians working more today than before the pandemic. So we have recuperated all the job loss, and we have more jobs today. Actually, there's more Canadians working today than in 2019. As a result, the unemployment rate is now 5.4%, which is lower than in just before the pandemic. And 5.4 is one of the lowest unemployment rate in the last 50 years. So this is consistent with our GDP number. So for the first 6 months of the year, and even, August is quite recent, the economy is still performing quite well. Why is that?
Well,
this 3.
I'm just going to interrupt you there quickly, Kai. We seem to be having a little bit of an issue that the slides are running behind your talking points a little bit. So, because I believe it's actually Stu that's there we are. We're starting to catch up now on our slides a little bit. So, is this? I think you might
see
be
the consumption slide.
We're on slide 5.
Okay, I'm on slide 10. So maybe I should.
I figured we moved behind a little bit. Yeah, so I think
Okay,
Stu is in
let
fact
me
There we are.
controlling the. There
I just
We're with you now on slide 10.
okay, perfect. Okay,
Yeah.
so I understand that
Maybe,
somebody's going to move my slide. Is that correct?
yeah,
Or
correct.
Just
okay,
Yeah,
if you could
perfect.
give me cues, Pierre, I can change the
Perfect.
slide for you.
Okay, that's great. So there's three reasons why the economy has been performing so well. First one is consumption. As you can see from this graph, consumption has been increasing quite significantly since the pandemic. 5.9% growth. This is quite a strong growth. There's few reasons for that. Government program has helped Canadians during the pandemic, has put a lot of money in Canadians' pocket. Salaries has been increasing because of shortage of labor, because the job market is good, and there's more Canadians working than before. So all this together, as the result of all this, is consumption is increasing. Next slide is showing that the second reason why the economy has been performing well is commodity prices has been really elevated. Strong demand from the world. The war between Ukraine and Russia has created higher commodity prices. And as you know, we produce a lot of them in Canada. So when commodity prices are increasing, a lot of different parts of the country are making more money, or businesses are making more money because of that. And finally, the third reason on the next slide, business investment has been increasing since the beginning of second quarter of 2020. So for every quarter, business investment has been increasing, and this is also supporting the growth of the economy. So far for the Canadian economy, the economy has been performing very well, over capacity. And as a result, that put pressure on price. The next slide is showing our inflation rate. And as you can see, our inflation is much higher than what we have seen in the past. If you move to the next slide, you can see that we are at 7.6% now. Inflation went down in July, but slightly down. So, to the question, are we in a recession now? Well, we're not. The economy has been running very well, too well. So, we have a lot of pressure on inflation. So, if we look for the next 12 months, the next slide is showing that the Bank of Canada, as you know, has been increasing interest rate. The prime rate today is 3.25%. That's a huge increase compared to only 6 months ago when we were at 0.25%. And we believe the Bank of Canada will keep increasing interest rate because inflation is still high. So their strategy is to increase interest rate to slow down the economy and to reduce inflation. Inflation is quite negative for business. It's hard to plan, increase costs, reduce profit. It's also very negative for people, especially for low-income people. So the mandate of the Bank of Canada is price stability, and that's the reason they will keep increase interest rates. So this is what we should expect for the next few months, more increase in terms of interest rate. Having said that, if we go to the next slide,
Here, I
and
might
the next,
butt in
yeah,
for a sec. So as we hear about inflation, we hear about transitory inflation. Like it's not long-term inflation. Is that where we're at, or have we given up on that and said, no, this is the real McCoy?
I think we are past that point. I think
Okay.
salaries in Canada increased by 5.4% over the last 12 months. So people have been asking an adjustment in their salary because of inflation,
Yes.
and they got it in most cases. So inflation is not transitory anymore, and also it's going to take a bit more time to go back to what we would like to see around 2%. Probably it's not going to go away in the next few months. It's going to probably take at least a year. It should slow down every month as interest rates are increasing, but it's going to take some time.
Okay, thanks.
and yeah, maybe I'll just one follow-up question. The markets, they tumbled in a big way yesterday due to the American inflationary numbers being higher than was anticipated. So I guess in light of that, is the Bank of Canada, where we do align fairly well with the American economy, is our forecasted interest rate increases, do you think that that we recently had one, 75 basis points. You think that might be increasing, that they're going to try to maybe rein this in a little bit more, that they might have to up this? I see a forecast of 4% here, but is that going to need to go up to 4.5% in your view?
Well, I would say that's the plan. That's the plan to increase interest rate probably not more than 4%, because already at 4%, this should really slow down the economy. If they realize that the inflation is not going down, they might go higher. But the risk if you go too high is to create a recession. And obviously, what they are trying to do is to increase interest rate to slow down the economy, to slow down inflation without creating a recession. So, but they might have to go if inflation doesn't go down, as in the probably 8 to 12 months horizon. So my forecast is they are going to increase in the next few months interest rate probably to 4%. They will take a break and see how the economy, inflation is reacting to that. If it doesn't work, unfortunately, they will have to go further.
Is that basically the only tool they have to tamp down inflation, do you think?
The base to reduce inflation, basically that's the only tool the only tool they have. But don't underestimate this tool. I'm going to show you in the next slide that when you increase interest rate, you really have an impact on the economy. The last one I wanted to make on this graph is, yes, interest rates are increasing, but they're still relatively low in a historic perspective. They're still lower than in 2008, 2009, and much lower than what we have experienced, for example, 30 years ago. But nevertheless, the speed of increase, the pace of increasing interest rate is having an impact on the economy. And the first impact is on the next slide, is on the real estate market. This is the volume of sales in Canada, and as you can see, the volume of sales has really declined since the beginning of the increase of interest rate. And the next slide is showing that not only the volume has been going down, but the price as well. This is the average price of a house in Canada. So the average price dropped by 17%. You often see that in the media as something very negative. But you have to remember that the price is still much higher, about 20% higher than what it was before the pandemic. So we shouldn't look at the peak, as normal. The peak was not normal. People got a little bit crazy because interest rates were low. There was a pandemic. People wanted a bigger house and everything. So yes, the real estate market is slowing down, but it's basically a soft landing for now. If we look at the next slide, I have some data for Ottawa. This is the volume of sales for the Ottawa region. As you can see, it's really declining. However, the next slide is showing that the price is not declining as much as the average in Canada. The housing market in Ottawa is much more stable. So we're not expecting a huge decline in price for the Ottawa region. The prices are not going to increase for the next few years, but they are going to stay probably stable. So we already see the impact of interest rate increase. The next slide is the question, what will be the impact on consumption? The next slide is showing research done by the Bank of Canada. When they increase interest rate, you can see that the impact on each sector is different. The biggest impact is on new construction, on residential investment. We already saw that it's happening. Now, the next, it's big items. Are people going to change their car this year if interest rates are increasing? And you have, as you can see from the graph, you have an impact. When you increase interest rate on every consumption goods, the impact is a little bit different from one sector to another. So the question for the Bank of Canada and for us is how much the economy is going to slow down, how much consumption is going to slow down when they increase interest rate. We believe that the consumption is not going to slow down drastically for two reasons. The next slide is showing the portion of interest rate payment in the total Canadian budget. It represents only 6.14%. And this is the lowest in the last 20 years. Why is it the lowest? Because interest rates are low compared to 20 years ago, but also salaries have been increasing. People are making more money, have more revenue today than 20 years ago. So we believe that despite the fact that interest rates are increasing, the average Canadian can cope with that. Also, the next slide is showing that people have money in their bank account. Savings has been increasing significantly over the last 2 years. It's not surprising during every recession, consumers save money because of the uncertainty. Government program put a lot of money in Canadians' pocket. Salaries have been increasing. And as you may know, not remember, but for a period of time, we couldn't travel, we couldn't go to restaurants. So it was a good time to save money. So people, Canadian in average, have money in their pocket. It doesn't mean that the increase of interest rate doesn't have an impact on more on some Canadians. Some Canadians who have a variable rate, they have lower income, maybe their mortgage rate is very high compared to their income. But in average, most Canadians will be able to cope with the interest rate increase. So in the next slide, we try to summarize, well, before that, the business investment. We keep track every quarter of business investment intention. You can see that for the first time in 2 years, business investment are slowing down. So we are expecting that business investment will slow down a little bit as interest rates are increasing. They're not going to crash, but they are going to slow down a little bit. The next slide is making a summary of what's happening. So the first column is the first 6 months of the year. Everything is green except home sales. And the result is the economy has been performing very well. The next 12 months, you see much more red flag. Consumptions of goods is going to slow down a little bit. Business investment are going to slow down. So the next, if we go to the next slide, are we going into a recession? Well, not necessarily. Our number one scenario is a modest growth. This is our base case scenario. We don't believe we're going into a recession. We believe that the impact of interest rate, we believe the Canadian economy and Canadians are well positioned to cope with that. But the economy is going to slow down. But we also believe that it could be a recession. If we have a recession, it would be a mild recession. So the next slide is showing our forecast. So 1% growth for 2023, which is much lower than 2021 and 2022, but it's not a recession. It's still positive growth. And finally, my last slide is showing you the two different scenarios. So the blue dotted line is showing you a modest growth of 1%. That's our base case scenario. But we also could have a mild recession. And I want to show you on this graph that the difference between the two is not really big. And it's actually almost impossible to predict at this point. There's a consensus that we're not going into a deep recession like we had in 2020, where 3 million Canadians lost their job, or 2009. We believe that if we have a recession, it's going to be a mild recession. Our base case scenario is still modest growth, but there's a lot of uncertainty. All this will depend how consumers and business will react to the interest rate increase. If people put their brake on, well, we might have a mild recession. If people keep spending because they have a job, because they're still confident in the economy, well, the economy will just have a soft landing. So I'm going to stop here, and we'll have time for questions a bit later.
Yes, that was great. Thank you. So, but how dependent on the U.S. market are we? So, I mean, it's difficult to figure out what's going to happen down there, but they seem to be cooking right now. So is that short term? Are they facing the same things that we're facing?
They are basically facing the same situation. Inflation is high, although has been declining. I know the market didn't react very well, but actually as an economist, it's working. You know, they have been increasing interest rate, and now inflation is slowly going down. The job market is still very good. The unemployment rate is 3.7%, one of the lowest in the last 40, 50 years. So the economy was performing extremely well. Now it's slowly slowing down. That's basically what the Fed is trying to do. Again, the risk is the same here. If they increase interest rate too much, that could lead to a recession. But as today, the situation is very similar to the Canadian situation for the same reason. We have to remember that in 2020, the U.S. government put $5 trillion in the economy. So the economy has been performing too well. And that's the reason why we have pressure on price.
Thanks a bunch, Pierre. I think looking at that presentation, I think it's I think it's good news to see that there's either moderate growth or a moderate decline. What gets, I'm sure Craig will touch on this as well, but what gets investors and consumers into trouble is volatility and wild swings going in either direction. So the fact that we've positioned ourselves or that we think that we've positioned ourselves to have a moderate growth or moderate decline, I think will do well for investors and consumers in our economy. So thanks so much, Pierre. I think that'll be a good segue to save. We got some more questions for you, but we'll save you a little bit, and we'll move on to Craig Bassinger, who's the chief strategist at Purpose Investments. So thanks so much for joining us, Craig. So we looked a little bit at the Canadian economy. What does the financial markets say? Are we in a recession, or is it?
Well, I'll point out the irony is that the economy and the stock market and the bond market very often agree at the extremes, but more often than not, they can clearly move to the beat of their own drum. So I thought I'd sort of, with a bit more of a market perspective, share sort of how we view what's going on, and I'll certainly incorporate a little bit of what happened with yesterday's CPI print. Let me just share my screen and hold on one sec. Everybody can see that? We're good?
Yes.
Perfect. Yeah, fall is coming. Yes, it's for those Game of Thrones fan out there. It's a playoff winter's coming, clearly, but it's not quite as dire. But certainly, this has been a tough year to be an investor. There's no denying that. It has been. Let me just get to. Yeah, it's been a tough year for equities. It's been a tough year for bonds, and I think a lot of. We can talk about recession, but I think it's also fair to point out this market has absorbed an inordinate amount of bad news since the beginning of the year. Everything, obviously, from inflation getting a bit out of control, and we can blame the central banks for leaving stimulus on too long, but the truth of the matter is when Omicron was coming out, nobody knew if it was going to be Omicron or if it was going to be Delta. And if it became Delta, then they should have kept the stimulus on. So, that's all sort of hindsight. But clearly this year, a lot of what has lifted markets in the previous year and a half coming out of the pandemic have reversed course. And, this market's absorbed, obviously, the inflation side. It's now starting to sort of sniff out slowing economic growth. We've obviously had a war. We've had spiking commodity prices. Like, there's been a lot of bad news to be absorbed over the first half of this year, and then around sort of in the summer months, we certainly did get a pretty strong rally. This is what happens. It probably a bear market rally in our view, and it was really just because the market had probably priced in a little bit too dire of an outcome, and Q2 earnings came in a little bit better than expected, which is more evidence that corporations have been very good at sort of managing these kind of volatile market and prices and demand. But really, I think, that was some of the good news that sort of had that relief rally. But I think as we move into the fall, and that's why we're highlighting fall is coming, this is a historically volatile time of the markets. I don't know if it's because, traders have come back from the Hamptons, or in our case, Muskoka, or wherever they came from. But September, October tend to be more volatile, and also historically have had a bit of more muted returns. And I think that's probably par for the course, because if there's anything we know about 2022, the volatility is not going away. So I'm going to sort of share, and this is, it's a little bit of economics, a little bit of psychology, but I find these two charts that I'm going to share really help put kind of everything we've gone through into perspective. So, and again, I'm going to lean on more US data here, just because, between StatsCan and the US data sources, the US tends to be a little bit better, but nonetheless, it's very similar in Canada as well. So this line on the left-hand side, and my slides are advancing, right? We're yes. Good. We see, yeah, okay. So this is spending on goods. So, stuff like iPads, TVs, furniture, renovations, houses, whatever you want to call it, but buying stuff, cars, RVs. And as you can see, like normally this kind of just grows pretty steadily with the economy, and then you get that little blip down there in the middle. That was the 2008 recession, and then it resumed its standard trend higher. And by and large, this is just people accumulating stuff for their homes and their life. But what happened coming out of the pandemic was quite interesting. I mean, we had a little bit of dip because everything shut down for a month, but then everybody's kind of started spending differently, and this has a material impact. And part of this, yes, this was fueled by stimulus as well, but it was also fueled by the fact that most of us kept our incomes, and we couldn't spend on a whole bunch of different categories that we normally spend money on. So we were sitting there and saying, you know what, I have a home office. I want my desk to go up and down in my home office, because why not? We've got money. We're not traveling. We're not going to eat out as much. So everybody started spending money differently, and they started spending money on stuff. And yes, there's shortages problem, yes, more lockdowns and logistics problems, but the fact is this spike in demand for goods, the economy just can't take. It's too much too fast, and that started creating shortages. Now, that's kind of the bad news of it, but the good news was that spending on stuff is better for the stock market. If you go out and buy a beer on a patio, it's okay. It impacts a few, pockets of the economy. But if you go out and buy an iPad, it impacts a whole bunch of the stock market and earnings of companies interrelated amongst each other. So there's a much bigger multiplier for the market, for corporate earnings, if you're buying stuff as opposed to services. And this really supercharged earnings. This supercharged earnings in Canada, the US, globally. And you coupled that with super low interest rates that were maintained low during because nobody knew what the path forward is going to be. And you got this huge run up in both the economy, the global economy, and a huge run up in the stock market as well. So yay, can't go out, can't get good food except from Uber Eats, which is a little questionable, but clearly good for the capital markets. And then fast forward to this year, and things have started to change. Now, the goods spending is still elevated, but it is starting to roll over because, again, if you bought an RV last year, chances are you don't need a new one this year. And we're now starting to spend money on services. Now, services is very different. This actually relates much more to wages and employment. And because service spending was so low for sort of an extended period of time, most of those industries just cut back on capacity. But now that the demand is coming back on the service side of the equation of the economy, we're starting to see where all the shortages are. It's no longer shortages in logistics, which is gradually catching up to the goods demand, but we're now shortages of the ability to deliver services. So when you go out to the restaurant, you'll very often have an apology that starts off from the maitre d', where he says, I apologize ahead of time for the service. These are all new staff. And again, that's just because they're still catching up. And that's why it's hard to find your luggage. And that's why we're running into problems on that side. And it's nobody's fault. This is just changes of behavior. If all of us change our behavior even 5%, it causes these massive ripples to go through the economy, to go through the markets. And that's what we're still dealing with, the reverberations of these changed behaviors. And now, obviously, we had goods inflation pretty strong, which is starting to slow a little bit, but now it's creeping into more of the service side of inflation, and that's wages. And that's what really scared, I think, the market yesterday. Market was hoping the inflation was going to start roll over a little bit. Clearly it had not, and it started to creep into other categories, hence what we've been going through on that side. Now, could we have a recession ahead? And I'll get into that in a second. And the fact is, these are such big sort of, let's call them waves going through the economy and through the markets back and forth. One of them very easily could manifest into some sort of a recession. But I agree with Pierre, there aren't excesses. So if we do run into a recession into 2023, it's probably not going to be one of those ones like 2008, which was financially capital markets driven, or maybe it'll be similar more to sort of the 2000 recession, soft recession, which was a little bit more of a Wall Street recession versus Main Street, where employment doesn't get impacted that much. And it's also possible, even rolling over on the goods spending could trigger like a technical recession. But at the same time, if the service industries are still catching up to the renewed demand in those categories, we could have a weird, and I know this is sacrilege from any economist listening, we could actually even have like a technical recession with strong employment, which clearly don't go hand in hand. So again, what I'm trying to highlight here is because of the pandemic, because it changes behaviors, we've had these massive changes, and these waves keep reverberating through the capital markets and the economy, and it's created a very unique environment that is unlike I think most that any of us have sort of ever experienced in the past. Now, have we passed peak inflation? And, clearly my slides were built before yesterday's US print. But I would say, a lot of the inflationary surprises are starting to come down. So that's certainly a positive. It is starting to get much better on the goods side, on the fulfillment side, on the backlog side, on the transportation side. The semiconductor situation is getting better. There's still shortages, not denying that, but they are getting much more manageable. And that's because that's how the economy works. If there's a shortage, even though there's sort of bottlenecks here and there, our economy is pretty dynamic. The global economy is pretty dynamic, and it's going a long way to sort of address some of those mismatches. And a lot of this chart on the right is the Citigroup inflation surprise indices, which have started to come back down in most parts. You'll notice the Eurozone went off my chart and is coming back down. It's a little bit different over there. There's a little bit more energy inputs into that. But the question now, of course, remains, and this is really the big question that sort of rattled markets a little bit yesterday. Shouldn't say a little bit, I guess that was a big rattle. But, I think people are sort of got their heads around, like, the durable goods side is starting to get more, and the goods side is starting to get a little bit better. But the question is, what's going to happen on the services side? And that's really comes down to wages. So wages don't fit into it directly, but that is a precursor for all the prices. And, I just booked a trip to go for business into Calgary next week, and I'm paying $500 a night for hotel rooms, which is, that's a bit extreme in that kind of environment. And so the market still, and yesterday's clear evidence of that. And even, yesterday was a big down day, obviously, in the market, but keep in mind the previous, 5, 7, 8 days of trading, the markets were up pretty steadily and pretty materially. So it was actually just a round trip in the short term. And really what the market continues to wrestle with is the inflation rate. If the market can sniff out when peak inflation has passed, then it can sort of price in how far the Fed's going to go. And, the Bank of Canada, people obviously care a lot more about the Fed these days. But, if they can start to even see sort of where those peak rates are and what level they're at, the market will calm down. Now, peak rates jumped higher yesterday. In fact, it's north of 4 now, where what is being priced in, hence the market tumbling a little bit lower. So really inflation is the big question right now, is probably from the equity markets perspective, the biggest wild card as far as how we're seeing prices react. And the inflation is becoming a little bit more incremental in the services side, and I think that's and it crept more into rents. So, it's certainly not the genie isn't back in the container, and that I think is still going to continue to be a pretty dominant theme in the months ahead. So now the big question comes down, is this year, are we headed towards, technically we're kind of in a bear market. If you want to look at the US market, it got down below 20%, and the Canadian market a little bit better. Just, based on our composition, we tend to hold up better when things like a war in Ukraine are going on. But nonetheless, the question at hand is, and this is the big question for investors, is this a repricing event in the markets, or is there a recession coming? And why the difference, why that matters, is because if this is an event driven, in other words, we're just repricing assets because assets got too inflated during the sort of year and a half coming out of the pandemic, and they did get inflated. I mean, when you see house prices go up 40% in Ajax, one of my analysts lives in Ajax, you kind of realize, like, that is asset price, that is a bit of an asset bubble, and that's starting to deflate now. So the question is, what we're going through this year, a repricing of assets because the risk-free rate is moving higher because of inflation and because of a number of other dynamics, or are we headed towards a global recession? Because for the stock market, that's a big difference. If this is just an event similar to 2020, similar to a number of other sort of exogenous shocks to the system, if it's just a repricing of assets, if that's what the event is, this is a buying opportunity 100%. If we are heading into a global recession, then all bets are off, and there's probably more sort of pain in the market ahead. But I would point out, and we're not in the camp that there is a material recession. I do have a hard time believing they're going to be able to manage a soft landing with this kind of an inflationary environment, and also coming from this elevated level. But Pierre's right. Like there's not that many excesses built up in the system. So if we did get a recession, it probably wouldn't be a material one. But it's still like that's the big question going forward. And if you look around the world, and this is where North America is actually in a better position, but if you look around the world, there is increasing concern out there. And again, this is all known. The market knows this. The bond market knows this. The inflation market knows this. But China's sitting there with clearly some problems. I mean, ignore the China stock market because it's very tech tilted. But if you look at the overall Chinese economy, they are dealing with a real estate problem, whether it's a bubble bursting, we can call it that, we can call it something else. But it is clearly an issue. This is our sort of canary for the Chinese real estate market, and this is all the developers listed in China and Hong Kong, pretty much equal weighted. And in our minds, until that bottoms and starts to recover, that'll probably be the early sign that China's recovering. But right now, it isn't. And why that's important is because China's been one of the big drivers of the global economy for the past 10, 20 some odd years. And worth pointing out, during the recession of 2008, China came to the rescue of the global economy and sort of pivoted a lot earlier and really put in a floor as far as from an economic perspective on growth. So China is important, but I think right now with the real estate backdrop, it is very unlikely they're probably a detractor of growth going forward as opposed to an incremental contributor. Not saying their economy is going to shrink, but just saying that from an incremental change perspective, it's probably getting worse, not getting better. And then you get into Europe. So this chart on the right is just the consensus forecast for the European economic growth from 6 months ago is the aqua bars, and then the blue is today. And what you can see is that, obviously growth expectations have been, getting cut. And I'm well aware when you look at consensus estimates on the economic front, this is, I don't want to say a lagging indicator, but it does react a bit slowly. And I really don't believe if it's dropping that quickly over the last 6 months that it's going to stop at zero. So Europe clearly is running a bigger risk of recession. Now, will it be a big recession? That I don't know. It is an exogenous shock driven recession. So, it's not like a fundamental excess problem, but still Europe is in obviously a tougher bind. And again, another detractor from global growth. Now, the saving grace is the US consumer, and the US consumer is huge. So, everybody knows the US economy is the biggest in the world, but the US consumer actually roughly makes up about 20% of the global economy. So they matter. They matter a lot more than us Canadians up here, just from a sheer size and dollar perspective. And the good news about the US consumer, they're not overly levered. And yes, job growth, hours, wages, all super positive. This is incremental dollars going into the US economy, and it is a material amount when you start to see overall incomes rising by that amount. So even though there's these, let's call them headwinds on the global side, the US consumer is very healthy, which is very encouraging. And again, in our mind, I think that would mitigate the damage or the downside on the recession if we do see one. But we do, we have to concede that recession risk is rising. So we use a number of we do a fair bit on rate of change, because really that's what sort of gives you sort of early indicators on what the direction of the economy. And Pierre hit it on the head, like higher central bank rates, higher yields has certainly been impacting the more interest rate sensitive components of the global economy. And we see that in our housing data, in the US housing data, things are softening. We're now starting to see it on the industrial side. And these are some of the bigger cyclical areas. Obviously, higher rates is negative as well. So we monitor a number of sort of market cycle indicators to give us sort of a clue as far as the direction that we're going in. And the global economy has been sort of soft for quite some time based on our indicators. So we're increasingly in the camp that the risk of some sort of global recession is high, and has probably moved from moderate to high at this point, because we're also starting to pick it up in corporate earnings as well. So corporate earnings have been like I said, part of that rally that we enjoyed in the summer from sort of mid-June to mid-August, part of that was driven by good Q2 corporate results in Canada and the US primarily. And, one of the reasons has been companies have been very good at managing higher costs because, with inflation, their actual top line revenue grows as well. So, you have been having costs come up, but you're also getting higher prices for per unit of production. And that's sort of maintained margins. But we're now starting to see that erode a little bit because I think the inflation, the ability to pass on prices is starting to slow a little bit, and the costs are still coming up pretty quickly. Everybody's getting raises, wages are rising. And again, that's not good for margins, and that's not good for equity markets either. So that's sort of feeding into our overall market cycle view and has us, again, we don't think it's going to be a material recession, but the probabilities of one certainly continue to move in the upward direction. So from a portfolio construction, asset allocation perspective, again, we publish all this. We have a weekly publication called Market Ethos. We also have a monthly portfolio construction publication. We've been dialing back a little bit on the equity side, primarily dialing back on the US side of late, and that was back in August. And again, that was predicated primarily just on, a bit on valuations and a bit on this sort of more tempered view going into the fall months, which tend to be a little bit more volatile. And I'll just sort of explain these two tables in the middle, and then I'll sort of wrap up. And really, we had to take a step. You take a step back and get out of the day-to-day kind of news flow and kind of look at what the market's pricing in. And essentially, what we're looking at here in the top table in the middle is for the S&P 500, so the U.S. equity market, and across the top is earnings, and going down the left is the valuation multiple. And the aqua sort of two boxes there, that's what's being priced in right now. And so really, the U.S. market's pricing in about 15% earnings growth. Now, do we think that's going to go higher over the next 12 months? Do we think that's likely to accelerate or decelerate? And I think at this point, the likelihood is that is greater risk of that decelerating than accelerating. And the other side is the valuations. The US market still trades at 17 times multiple. So now, to put that into perspective, that's the price divided by earnings. So it's how the valuation of the market. Now, that's kind of historically normal for the past 20 years. But also the last 20 years, we've had low yields or yields moving lower. And that isn't the environment today. So if you actually look at a longer term valuation history of the S&P, especially in periods with higher yields or yields closer to where they are today, the multiple has typically been closer to 15 times and somewhere around there. So, you put those two things together, we just think we want to be more cautious on the US side of the ledger. And why we didn't reduce on Canada, the Canadian market obviously has benefited from a lot of real assets, has a value tilt, which has made us, one of the better performing stock markets year to date. Again, better performing year to date is all relative because that's not great. But the valuations in Canada are much more reasonable. We're much cheaper. The earnings growth is much lower as well. So I think Canada is probably pricing in a little bit more higher risk of a recession. That's why we're a little bit more constructive in the Canadian side of the ledger and a little bit more cautious on the US. But again, I think 2022 has been a challenging year for investors. It's been a repricing of assets. We've had the bond market feeling pain. We've had the stock market feeling pain. One of the good aspects that sort of put a bit of a silver lining on it is, everything that we've sort of talked about, the path of central banks, path of Bank of Canada and the Fed, the risk of a recession, this has all been so talked about. Like, if we actually do get into a recession, I think this might be the most talked about recession in my career ahead of time, because again, they usually surprise the markets, and this one, when everybody's talking about it, it probably sort of mutes or prices in a lot of the bad news already. And I think that's kind of where we sit today. So I don't think I don't have a rosy finish to the year. I do believe the market, both the bond and equity market, have priced in a lot of risk and a lot of the storm clouds that everybody keeps talking about. So I think that has a little bit more of an opportunistic view going forward. But I still think it's going to continue to wrestle with sort of that path of inflation, because ergo that feeds into the path for central banks, which leads into the path for bond yields. And I think that path is still going to remain pretty uncertain over the next couple of months.
Very good. Thank you very much.
No problem.
Pierre, I might ask you one question. You talk about potentially a mild recession. Is that mild in both depth and length? So, would it typically be 24 months, 12 months?
Probably less than that. Basically, the economy, and Craig was talking about that, how much people spend money, both in Canada and the US. So we have been spending too much money, pressure on price. Now interest rates are increasing. But basically, the economy is not sick. The economy is not in a bad shape. It's just need to breathe for a while. And that's what we are expecting for the next 12 months. The economy is going to slow down, like I said, slow growth, a mild recession, but it should be just for a short period of time. And we don't see a major shock that will create a major recession.
Great.
Thanks.
And this
Um,
US dollar, sorry, go ahead, Elliot.
Yeah, I have one, I guess both for Pierre and Craig, but maybe Pierre, if you wouldn't mind answering first. So there's a lot of talk around, peak inflation. Of course, we've been chatting about it a lot, and we're looking at the overnight lending rate chart, that we are still quite a fair bit lower than our historical average would be, and that 4% marker was still, a lower than what the average should be. So, we clearly, the Bank of Canada and the Fed, they want to keep inflation somewhere between the 1 to 3 range, 2% being the ideal number. I guess, in your opinion, what is a comfortable, in the new economy, what is a comfortable interest rate, where the economy is kind of chugging along as it should, to be able to get the inflation rate back down to our ideal 2%? And then what kind of, as we talked about, the outline, nobody likes the volatility. What kind of timeline would be looking at, in your view, to be able to affect that change without, disturbing or rocking the economy and financial markets too much?
Yeah. The Bank of Canada calculate what they call a neutral rate, a neutral interest rate, which is an interest rate that doesn't stimulate the economy, but doesn't limit the economy. And this natural rate for Canada is around 2.5%. So when you go over 2.5, you slow down the economy. So that's exactly what they are trying to do now. So when inflation is under control, interest rate will go back to this neutral rate, which is around 2.5%. How long is going to take? Probably a year. It takes time to reduce inflation. But there's also, we haven't talked too much about it, but there's two good news in terms of inflation. Supply chain issues was part responsible for inflation, and it's improving now. It's slowly improving, but that also will reduce pressure on price. The war in Ukraine, as you remember, probably really increased commodity prices in the spring, but most of these commodities have been going back to the pre-war level. So this is helping inflation as well. So it's probably in a year, inflation will be back to more reasonable level, around probably 2-3%, and interest rate, the central banks will be able to reduce it, to go down with the interest rate to what we call the neutral rate, around 2.5% for the prime rate.
Will that reduce so I know the soaring US dollar seems to have a lot of effect on, and I think Canada's kind of keeping mostly lockstep with it, but some of the other economies of the world, is that all going to unwind as well in the next year or so, or is that a permanent sort of thing?
Well, we believe that the dollar is at 76 cents today, very close to 75, which has been is historic level for a long time before the pandemic. So we believe the dollar is going to stay around that level. This pressure to increase, commodity prices is typically pushing the dollar up, but the US dollar is very strong right now, which is reducing our Canadian dollar. The dollar, when there's a lot of uncertainty, a lot of turbulence, the US dollar is always is stronger. Investors still go back to US investment. So that's basically what we are seeing now. The US dollar is strong. The Canadian dollar will stay around between 75, 77 cents for the next 12 months. That's where we see the Canadian dollar.
I'd add on the currency side, it's been because again, like the US dollar obviously has been the superstar over the last little while, and the Canadian dollar it looks like we're not the superstar, but we really are. We're just kind of not quite keeping up, but we're still certainly in decent shape. But you compare our currency or the US currency to the yen or the euro or the British pound, it's obviously a completely different story. And these are actually massive moves in the currency market. So even though equity volatility has been higher this year, like currency volatility is even more so from a normal historical perspective. Not higher than equities, but higher from their own sort of normal kind of paths. And it is worth noting that a lot of the currency fluctuations is being driven by countries with better food and energy security and independence. And that has been a big determinant of why the euro is so weak and why the yen is so weak relative to sort of us in North America. And that's one of the good news. Like the good news is we're in North America, which is actually one of the better places in the world to be right now.
Yeah, I would agree with that. I think
Yeah.
Europe is having a tough time, mostly because of the energy, because of the war in Ukraine. You know, they were, especially like Germany and Italy, they were counting on supply of energy from Russia, which is not happening right now, which is really causing difficulties. And China is really struggling with COVID-19. Their vaccine is not as efficient as the vaccine we're using here. They still have a large number of cases, so they're still fighting with that. So really, the North American economy is in the best position right now.
But if you want to travel, it's better to go to Japan and Europe at the moment.
Yeah, prices are really high right here. Yeah.
So we have one question here I'd throw out to you. It's historically when interest rates have increased, this has been accompanied by increased rates for banking retail consumers. This is not happening now. Why not? I'm not certain if that's the case, but maybe it's
No.
not happening.
Well, it's increasing. I mean, the mortgage rate is increasing both for the consumer and on the business side. Like I said, we have to put this in perspective. You know, the mortgage rate right now, it's about 5%, which
Yeah.
just seems high compared to, 2020, but we are old enough to remember that mortgage rates used to be much higher than that. So it's all like, yes, interest rates are increasing, but they are still relatively low compared to, the historic perspective. So that's the reason why we believe that the average Canadian are well positioned to deal with that. Same thing with businesses. Business investment are not slowing down according to our research because interest rates are increasing. It's more about the uncertainty. There's so much uncertainty. So there's a fear of a recession. So that will probably slow down investment. But when you look at the numbers, profit are at an historic high. And Craig mentioned that before. It's true that the cost of doing business has been increasing, but actually most businesses were able to increase their price. So actually, when we look at the profit has been increasing since 2020, since the pandemic, every quarter, and they are at a very high level. Businesses are cash rich in Canada. They have, a marge de maneuver. They really have they have saved money over the last 2 years. Businesses has been performing well, so they are well positioned for a slowdown in the economy.
Thanks. Another one from our viewership here, and Craig, maybe I'll point this one to you. So, you mentioned briefly in your slides, I guess, how rent increases kind of going forward might have an impact on inflation. Is that going to be, as house prices come down, but rent seems to continuously increase? Will that have a marginal effect on the inflation rate, or what would be the overall impact?
Yeah, as with everything in the economy, there's usually a delay, and there's typically a number of quarters. I think most studies sort of put it at a year to year and a half between changes in housing prices and the impact on rents. But you throw in higher interest rates, and I think this economy now reacts faster than a lot of the old sort of rules of thumb as far as reaction times. But that's starting to be a contributor to inflation, and that'll probably continue even with house prices starting to come down, because again, it's a lagged effect. But I'd also, I would also caution, like, CPI inflation is very backward looking as well, right? So, these prices, this is what's happened over the last year. So yes, prices have gone up a lot, but for when it comes to investing, that's nice, but it's kind of more important what's going to happen next. And I think the good side of the equation is starting to get a little, a fair bit better, but yeah, the services and rent and that side of the equation on the inflation side is still unknown, and everybody has their own anecdotes on how much it's costing to do anything in this day and age. And it sure feels like higher than 8% inflation, but that's par for the course. But it's also, keep in mind, very backward looking. Same with employment too, right? So, I think these things are going to start to sort of roll over and get more healthy as things are starting to slow down. Companies aren't hiring as quickly. And whether it gets us all the way down to recession or not, I guess, clearly that's the big question out there. But I would also say this, the markets are more concerned about inflation than they are recession. And if we do get even a mild recession, I mean, that would be perfect in my mind. That's just as good as a soft landing, because that's going to start to alleviate a lot of these other problems, because we do have problems in the economy. Part of it's inflation, part of it's, the ability to find workers. I mean, people are now demanding that they work from home all the time, which is, a recession solves all that. Like, people then say, no, wait, I need a job. And instead of saying, I want to demand higher wages and sit at my home office all day.
Yep. As we look at general grocery prices that, according to my wife, are out of control now, do we expect we're going to have to catch up with them, or do they think they might come back down a bit to earth, or is that pretty much set now?
The reaction speed of inflation coming back down, prices coming back down, is much slower. So one can hope, but
yeah.
So Craig,
Well, the pressure on food is the pressure on price for food is going down. There was a big pressure in the spring because of the war in Ukraine. Now the price of wheat, for example, is really back to normal. So we should, I don't think price will continue to increase the way it did. Is it going to go back? Well, my experience is usually when prices are increasing, they don't go back very quickly. So they might not go back to the pre-crisis level. But I think the pace of increase is going really to slow down.
maybe one final closing question, and maybe I'll direct this to you, Craig. So there's there's some 2022 left. What opportunities would you see in the marketplace, and what areas would you think might be worth or having, maybe not avoiding entirely, but reducing exposure?
Yeah, I mean, one aspect I would caution, and this is just from sort of other client events and conversations with both advisors and clients, is, even though, like, there's a lot of storm clouds that everybody sees and everybody's talking about out there. But keep in mind, like, this is all really well known. So, I think, running away from the market in this environment, and because of a popular ideas like, oh, why don't I just buy a GIC and get 4 or 5% and be done with it? I think that's potentially just as risky, because I think a lot of the bad news has been priced into this market. So even though we still think there's going to be volatility going forward, I think the opportunistic valuations and the setup going forward is much healthier. And then even the bond market, and for anybody who owns bonds, which is probably everybody to one degree or another through a vehicle or directly, bonds have been pretty painful this year. This is the first bond bear market we've seen in a long time, and this is supposed to be the part of your portfolio that's stable, that just spits off some income. But the neat thing that bonds have that equities don't is every sort of tick lower in price, while painful, improves their future return. And you can now, there's the market, the bond market, the equity market, it's a wash in yield. Like, there's lots of yield to find out there. And I think that's a bit of an opportunity. So I think, extending duration, inching back in, adding a little bit on the bond side, and also maintaining that sort of equity component is the right path. Because in my mind, as soon as inflation starts to roll over, which again, we can all debate when it's going to happen. The market kind of thought it was going to be yesterday. Clearly it wasn't. But I think when that inflation starts to sort of at least start the long journey back down, the equity market and the bond market are going to both respond in a very positive way.
All right. Well, I think we're just about out of time. Thank you very much, gentlemen. That's been very helpful. I hope everyone who's been listening now has a better understanding and maybe is a little less worried than they were when I was reading off those headlines at the start.
The closing,
Right.
this webinar will be available. The recording will be available for a rewatch. If you might have missed something, please we'll send a note out and it'll be available through the Welch LP website.
Excellent. Thanks, guys.
Thank you.
Sure.
Have a
Thanks,
good one.
everyone.
Yeah.
Good to see you.
Bye-bye.